Welcome to the Karma School of Business, a podcast about the private equity industry, business best practices, and real-time trends. I'm Sean Mooney, Blue Wave's founder and CEO. In this episode, we have what I think is really a pretty fascinating discussion about what Blue Wave saw and reported in its Q2 2025 Private Equity Insights Report, which really illustrated what the best business builders in the world, many hundreds of private equity firms, did to navigate through the flock of black swans that presented themselves during the second quarter of this year. Enjoy. So today we're going to talk about what we've seen and captured in the Blue Wave Private Equity Insights Report for the second quarter of 2025. With all candor, this is probably one of the more interesting quarters that I've ever seen. And I think probably one of the more illustrative quarters that describes kind of the private equity way in terms of how they respond to disruption, understand what's going on, take action, and then adjust and move and shift and take action and move forward and adjust and move and shift. And so this is a really terribly interesting quarter and probably one of the more fascinating ones I've seen before. Maybe to start things off, I feel like, and as I've said this before, we've all been living in kind of perpetual stop and go traffic since COVID. So we had COVID kind of turbo stimulus that came in, hyper overheated our macro economy. The engine almost like completely stalled out as inflation kind of out of control, and then everything's kind of started grinding to a halt. Then we started taking action. We started getting under control. Really, a lot of the economy, if you look at the data, was in recession. If you pull up our GDP, particularly 2002, 2023, even parts of 2024, you saw the manufacturing industry in mostly recession. You saw this in healthcare. You saw this in kind of non-AI tech. What happened, though, since then is the economy would get going again, and then something would happen. There was a fender bender, and the stop-and-go traffic would come to a stop again. So it would get going, and then you've got inflation. It get going, then the elections that would occur. And then you have a regional wars, and then you have April 2nd, the tariffs. And every time, somehow this amazing economy, which is surprisingly resilient, just picks up speed again. And I've been kind of fascinated and once again, just amazed by how resilient our economy has been. And one of the things that I was listening to most recently was a discussion by Morgan Stanley's chief investment officer. And I was heartened because he agreed with a lot of the things that we've been saying for the last, at this point, north of a year, where he said, we're moving now from a rolling earnings recession to a rolling recovery. And I think that very much fits with the metaphors we've used with this stop and go traffic. What I think is, if you look at our data, and we'll talk about some of the disruption that occurred in the second quarter here, but when I look at the data, it really looks like we've been on this bumpy bottom of an economic cycle. We're getting ready to introduce stimulus with the large tax bill that was introduced and signed. We're getting ready to lower rates. And so I believe that we are phasing into the next 3 to 5 year growth cycle. And it's always bumpy at the bottom and it's never straight up and to the right. But we're going to be doing a sine curve up and to the right over the next 3 to 5 years and getting into more of a traditional economy, a traditional cycle, not one of these 15-year kind of Fed-fueled mega cycles. With that kind of framing, let's talk about what we saw in the second quarter. And what was kind of fascinating in the second quarter is going to the end of the first quarter, all our signals were booming. And so if I look at our year over year volumes, just absolute volumes that were coming in March, they were up 45% year over year. Every banker we were talking about was getting ready to bring all these deals to the table. The deal economy was getting ready to roll. I think performance was good. People were excited about deregulation, excited about lower taxes. And they were concerned about the magnitude of what then occurred in April 2nd. And I think we had seen some things start to slow down in March in anticipation of April 2nd, but no one could have predicted what was ultimately unveiled on the world. It was much bigger, much more expansive. It was a cold cup of water thrown on the faces of business builders, and no one was ready for it. And so what we saw then was this shock on April 2nd. And then this jolt, and things came to a kind of a screeching halt once again into like fender bender. Go traffic went to stop traffic. But then as the quarter progressed, what was really fascinating is we see these projects come in from many hundreds of private equity firms and thousands of their portfolio companies, which gives us a lens into what the best business builders in the world are doing, where they're doing it, why they're doing it, how they're doing it, how this changes in time and over time. What we saw there is they all started taking in information. They started analyzing what was going on. They started formulating action plans, and then we saw them roll into action after they decided what to do and then iterate rapidly. And so we've talked about this before. For those of you who are interested in this kind of framework and thinking, it looks a lot like what's called an OODA loop. And this was formulated by a military strategist named Colonel John Boyd, really coming out of World War II and into kind of future campaigns, where it's a decision-making process of where you observe what's going on, you orient/analyze, you decide what you do, you act, you see what happens, and then you go all the way back and see what happened, analyze, decide, act. And so we saw that once again. We saw that during COVID. We saw that during the inflationary periods that came out of that. We saw that during the election period. We saw this during the second quarter. And so what happened was, as you look at the second quarter, now we've gone from the April boom cycle to the dramatic halt. We said, once again, not only the PE sales came in, but so did the macroeconomic one. So we saw the S&P manufacturing PMI go from 53-ish%, which signals some pretty good expansion of people making more things in the US, and dropped right down to just over 50, 50.2. And so that means we're like highly neutral. They're not expanding, not contracting, but that's a pretty big pullback. We saw consumer sentiment plunge from around 65 in February all the way down to 52 in April. And then we saw the VIX go up in April from kind of mid-high teens, which is like normal time, going all the way up to mid-50s. And I think at some point it might have been even a little bit higher. And so you think about the VIX, for those who don't know, the volatility index, it's really a measure of fear and anxiety in the business world. When it goes really high up, there's a lot of volatility, which means there's a lot of fear, there's a lot of anxiousness. So it spiked in April towards the historical levels of high. All of that was because no one had thought that the tariffs were going to be anywhere near as large as what came out. And then what happened is, though, as we looked into the quarter, private equity started going through their OODA loops. And so we saw activity within private equity absolutely in April go down about 15% year over year, after being up nearly 45% year over year. So we saw a big pullback in April. We saw, as you can imagine, in the manufacturing world, projects that were in that sector, we saw that world go down 29% year over year from an absolute activity level, which was kind of striking. And then what we saw was, once again, the private equity firms, they analyzed what was going on. They were observing what's happening. And then as the quarter progressed, we saw them leap into action. So what happened in May after manufacturing went down 29% year over year? Well, a lot of the private equity firms, took action to secure the safety of their companies, doing tons of tariff activity, logistics activity, procurement activity, everything they could to kind of reorient their supply chains for success. But then what we also saw was a huge amount of actual underlying activity related to making growth investments in new manufacturers themselves, because there was a realization that these policies are going to cause a massive amount of reshoring of manufacturing capabilities, which, if you recall from our fourth quarter end of year report from last year, and even previously last year, this is a strategic initiative to reshore manufacturing, not only to recreate middle-class jobs, but also from a strategic perspective as it relates to geopolitics, so we own the means of our production. And so we saw OODA loops, observation, orientation, decision, and what happens in May, manufacturing-related activities in that sector goes up 27% in May, another 14% in June. Hey, as a quick interlude, this is Sean here. Wanted to address one quick question that we regularly get. We often get people who show up at our website, call our account executives, and say, hey, I'm not private equity. Can I still use Blue Wave to get connected with resources? And the short answer is yes. Even though we're mostly and largely used by hundreds of private equity firms, thousands of their portfolio company leaders, Every day we get calls from everyday top proactive business leaders at public companies, independent companies, family companies. So absolutely, you can use this as well. If you want to use the exact same resources that are trusted and being deployed and perfectly calibrated for your business needs, give us a call. Visit our website at bluewave.net. Thanks. Back to the episode. The other thing that we saw was that private equity kind of looked through all of this noise during the second quarter and started making very fundamental investments in technology. And so this was really throughout this whole pause and period. And so in March, we saw technology activity, absolute project volumes go up 54% year over year. And then April, we saw it go up 70% year over year. In May, it was a little bizarre. It actually kind of was more like 5-10% up. And then I think as people started leaning into what's going on and the AI stuff is coming out and it's a buzzword and everywhere, we saw AI activity in June for projects related to not only AI, but data, but also the software tools that use AI, and then also AI enablements themselves. In June, we saw that go up 118%. And so as the quarter progressed, private equity observed what was going on. They analyzed it. They decided what to do, both in terms of this black swan that flew by on April 2nd, but also longer term, and they started hitting the gas. Then, just as we saw kind of in PE, the rest of the world started waking up eventually too, as they saw that these tariffs at the end of the day are getting accepted. They're getting rewritten. We're rewriting kind of the basis of trade across the country in ways that I think have surprised most, including me. It's been much more kind of effective in the implementation than I feared. And then suddenly what happened is you then saw PMI go from 50.2 in April all the way back to 53 again. So the manufacturers in our country started expanding again. The consumer sentiment index that we previously saw plunge down to 52 in April is now back above 60 in June, right? So everyone's like, oh, it's going to be okay. And then the volatility index went from the mid 50s all the way back down to the mid to high teens again. And so we kind of went through this not only as an industry and private equity, but also as an economy saying, wow, we were all kind of shocked and awed at the beginning, but then we realized this looks like it might actually be working. Now, time will tell. There's obviously things that we're all still concerned about in terms of inflation. A lot of the consensus right now on inflation is that it's going to be kind of a one-time push through, and then this gets kind of priced in. At the end of the day, it's just a quick aside. Here's how I view the tariffs. It's politically not palatable to say we're raising taxes, but we have to because of all of the debts that we've taken on, not only before COVID, but particularly in COVID when we introduced this huge amount of stimulus into the world. And so it's just politically not acceptable in this age, or certainly in this votership, to raise taxes, but you can do tariffs. And so the way I'm viewing the tariffs is this is essentially a tax increase that we can push through that will help us fund the government spending that's underway. Now, I think a lot of us who realize the kind of the great challenges that we have as a nation related to our government spending overall, I think we all still want to see government spending going down. We'll have to wait and see what comes with that. Now, here's a quick another aside that I just find very interesting. If you were to overlay today's revenue against pre-COVID 2019 government spending, we'd be in a surplus right now. And so just let that marinate. There's a lot of expense that we justifiably put into the government spend as we try to not recreate the conditions that created the Great Depression in the 20s when all the spending got pulled in. So we learned that lesson. The problem is we never took our foot off the gas, and we haven't taken that extra spending off. I'm not trying to venture into anything political. I'm trying to say just as it relates to spending across all categories, I think most of us can agree that we're spending a lot, and that's got to change. And so please don't take that as any one political affiliation or another, because we are absolutely agnostic here. But from just a means, and you got to live by your own means, is something that I think most of us can agree on, that we've got to figure out more ways to kind of address our spend versus our revenue. Hi, this is Sean. Wanted to take a quick moment to tell you a little bit why Blue Wave exists. It's based on this whole notion that assessing opportunities and building businesses is really hard. We all know third-party expert service providers can dramatically help, but at the same time, it's hard to know who's good. Usually leaving you like I would do and call friends and ask, do you know someone who does this? Or just go the square peg round hole route. So after nearly 20 years in PE, I decided to solve my own problem and created Blue Wave. Today, many hundreds of PE firms, thousands of portcos, leading public companies, private companies, all call Blue Wave to instantly get connected with the exact third-party service provider they want that's pre-credentialed by Blue Wave and perfectly calibrated for their need and really good. You too can give us a call or visit our website at bluewave.net. We're free to use and you can benefit the same way other top PE firms do. Back to the show. So what have we seen then coming within private equity? We talked about in the beginning in March, booming activity. April, really a lot less. And then in May, we started seeing kind of 5 to 10% increases in absolute volume. In June, we saw the same thing. But then July, as we looked forward, outside of that quarter, we started seeing very high ramping of activity. So 25% year over year increase in absolute volumes. You go from boom in March, bust in April, May and June, people kind of calibrating and seeing what's going on, breakout in July. I think that bodes very well for the rest of this year. And I think that at the end of the day, it's going to bode even better for 2026. One of the key data things that came out, I think that people have been concerned after the quarter, was the jobs report. As they recast the jobs report, one of the things that I think was evident, at least in the numbers that were produced, was that maybe the job market isn't quite as hot as people thought. One thing I'd like to just reframe for people. So we went from a 4.1% unemployment to a 4.2% unemployment. 4.2% is still very, very much in the hot range. And so it's really when you start getting above 5% unemployment that you're signaling some meaningful issues in the job market. But if we're still at 4.2%, that just gives us an indication that when coupled with 3% growth in GDP, you've got consumer sentiment strong, you got the PMI expanding, you got 4.2% unemployment, the economy is kind of shockingly in decent shape. And so I think all of that is giving business builders of private equity more and more conviction that it's time to go. One of the things that we haven't seen yet is a huge breakout in the deal market. I think we've seen some of that. We've seen some of the PitchBook data was showing the first quarter exits were about 6% up in private equity. That's decent, but it's not the big breakout that we're expecting. One of the things that if you look at the same thing in that quarter is that the new deal to exit ratio was about 3 times. So for every one deal they're exiting, they were buying 3 more companies. And so as a result, what we're kind of meaningfully seeing in PE land is that they're still adding more than they're selling. As I think a lot of us have heard in the PE world, the LPs are saying, listen, private equity firms, if you want more capital, you got to return capital. The average age of the portfolio companies' holdings in private equity is at or near all-time highs right now. So what we're teeing up for, I think what we're setting up for, is eventually a huge breaking of the proverbial dam where lots and lots of companies are going to be coming to market. Now, whether we see that in the traditional peak deal season post-Labor Day this year, I'd be kind of surprised by that, but I think it certainly sets something up big time for 2026. We'll find out, because I know from our market checks in the first quarter of this year, there are literally thousands of companies that have SIMs written by investment bankers that are ready to come to market right now. So we could be surprised. Be on the lookout for a major deal breakout. I'm getting out of that prediction business because it's just too hard to tell. But I think everyone can agree that there's a lot of companies that need to come to market that eventually will. And we're in a good enough economy that's kind of surprisingly almost better than good enough. And at the end of the day, as we look at our private equity priority index, which measures growth versus kind of like profitability or taking out costs, so growth versus cost maybe is one way to think about it. Private equity is still very much in the growth phase, which signals that they are still very much positive about the future. So that is the high-level update. I think the other things that we're seeing, private equity is still investing tons in people. We're still getting lots and lots of needs for specialized, excellent recruiters, interim executives. Technology, as we talked about, is booming. Strategy is still very important. So we're getting really demand across every functional area in the companies. To me, as a professional skeptic, that dares me to be optimistic in a time where it's been really hard to, or certainly fatiguing to, because we keep on getting into the stop and go traffic. My sense is little by little, the roads are opening up and we're picking up speed, even if it's not very perceptible at the time, as you still seem to be bunched up in kind of the traffic of the day. But as I dare to look around the corner, it seems like it's opening up. Now, all of that is, of course, provisoed by the fact that if another black swan comes in, all bets are off, right? But at the end of the day, I think things are getting better. The conditions are here. My bet, if I were a betting person, would be that we're entering into the next growth cycle. And I think Morgan Stanley recently agreed with us. So hope this is something that gives you some actionable information. If you'd like to request a copy of the report, please reach out to your Blue Wave account executive or visit a link that we've placed into the notes of this episode. And we'll do everything we can to support not only the safety of your businesses, but also the success. Let's go get it and onward. That's all we have for today. Please continue to look for the Karma School of Business podcast anywhere you find your favorite podcasts. We truly appreciate your support. If you like what you hear, please follow, 5-star rate, review, and share. This is a free way to support the show, and it really helps us when you do this, so thank you in advance. In the meantime, if you want to be connected with the world's best-in-class, private equity-grade, professional service providers, independent consultants, interim executives that are deployed and trusted by the very best business builders in the world, including many hundreds of top private equity firms and thousands of their portfolio companies, and you can do the same whether or not you're in the PE world, give us a call or visit our website at bluewave.net. That's BLUWAVE, and we'll support your success. Onward. The views and opinions expressed in this program are those of the individuals presenting and do not necessarily reflect the views or positions of any other persons or entities, including those referenced herein. No representations, warranties, financial, legal, tax, or other advice are made herein. Consult your advisors regarding any topics discussed during this episode.